So we have a very, very different perspective on time. Time is our friend. You know, this anxiety affliction that all traders seem to have is because time is their enemy. You know, they're anxious if they're out of the market, and they're anxious if they're in the market. They don't know why they're out, and they don't know why they're in. So, you know, you can sit there, hopefully, and be comfortable not being in the market. Because what you're doing, you're trading time. Implicit in development of anything is a time variable, and you use time to analyze situations, and you use time to analyze trade management and your strategies and your tactics and trade management and targets. If let me ask you a question. If if I enter the S&P, if today, for instance, if I had entered the market all right, I entered this trade right in here somewhere, and this was, I think, the Globex. This was the day session low right here. Okay, this is the day session low right here. Now this was a classic market condition, market structure trade. So I entered this trade right in here. It wasn't the first hour. It might have been the first 90 minutes. But if I had entered this trade, what was my time target for the trade? You know, if let's say it was 10:45, the market had been trading for 75 minutes. How long did I expect to be in that trade? Probably all day long, right? And that's something else, especially in the stock indices. You guys go back and review some of these webinars I've done recently and trade lessons on trade location in the equities, because if you can get that trade in the morning off of the previous day's high or low and the Globex high or low with a divergence, you know, you've made your day easier. Sit there and enjoy the ride, and it might take all day long. If anything, you want to look for the opportunity to add to the trade. But that's using time and understanding development. You know, if I get in a trade, if I enter a trade in the stock indices between 9:30 and 10, it's with the intent of having caught something that is close to either the high or the low of the day. You know, I'm not interested in three handles. If I'm getting in at 9:30 or 10, I want that outsized trade relative to the risk that I'm taking. You know, if these guys that get in these trades in the morning, and it goes three handles their way and they immediately jump out, it just doesn't make sense. They're not using time. Time is our friend. All right, hold on a second here, guys. So time is a market condition. It's one of our market conditions. And it comes into play in some very explicit, obvious ways, and then it comes into play in some more subtle ways, and we'll talk about that a little bit too. I mean, time can help you determine what not to do and why, and it can help you determine what to do and why, just as a balance area can in trade location. You can use time the same way. So you've got, if you're strictly trading intraday, the clock is ticking, literally. And if you're entering a trade late in the session, you know, I really believe you should be prepared to carry the trade into the next session. And if you're not willing to do that, you have to question, you have to have had a really good reason to take that trade. And this is a really key point, guys. Market development cannot be chronologically confined. You know, there's this popular theme among the advising industry now is that you know, you get up in the morning and you read the sports page and you drink a cup of coffee and you turn on your computer and you trade at a certain time every day, because that's when it's happening. And then, you know, you trade for 15 minutes and you make a lot of money and you're done for the day. And that doesn't take into consideration the fact that the market doesn't care what time it is. The market is following this auction process of trade facilitation. And there are times like when the pit opening and the crude and things like this where you know, things can be more volatile than others. But what you're really trading as an auction market trader is you're trading market development. And you know, you at your entry, you're lining up development and condition, and it's incidental to a specific time on the clock. So if you are a day trader, you've got to be aware of, you know, if it's 3 o'clock in the afternoon and you're thinking about entering a trade, you know, you're trading the S&P, I will enter trades at 3 o'clock. I mean, I'll enter trades at 3:45, but you have to really know why you're doing that. And if you're entering it after about 3 o'clock, you've got to be willing to carry that trade over into the next time frame. And it's not, and in this day and age, guys, you don't have, I mean, you have minutes of exposure between sessions. Now, Sunday or Friday afternoon is a different story. I can understand that. You want to be hedged or something like that. There are ways to do that. And we'll talk a little bit about that next week. But there's no reason whatsoever to freak out because the day session closed and you're in a position at the market. If you look at it, you can't usually tell where one session ends and another one begins. So you don't want to artificially constrain your trades. Okay, let's talk about another favorite of a lot of people, spikes. It's very attractive to, in some markets they're spikier than others, and gold and crude are two very spiky markets. It can be very appealing to play let's catch the falling knife or let's stand in front of the train. And those trades will work a good percentage of the time. The problem is that even if they work, when they work, you don't know, you don't have a basis for taking your profit, and the reward to risk isn't there. You can't define your reward to risk. The people that buy spikes, they get in and then they get out very quickly if that trade begins to work. So they always miss the benefit of having caught the low tick, and they also get run over periodically trying to buy a spike or sell a spike. And volume can be very deceptive. You know, one of the things that you can do, and I'll show you, I've shown this before, you can use volume to identify the potential for a spike, but it's just a really, really, really bad practice to habitually fade spikes. It's unnecessary. Most spikes are retested more than once, and the ones that aren't, they're not tradable anyway. So don't make this part of you have no business, if you're not an experienced trader, you have no business even trying it. But if this is something that, you know, fits your personality and you want to do it once in a while, that's fine. But don't make this a primary part of your trade plan, because it's a tough way to make a living. You know, you're missing the huge benefits of this methodology if this is what you're doing. and it's all you're doing. So here's a spike. It's overbought. You want to sell it? No, you don't want to sell this. It's unnecessary. Do you want to buy it? I don't want to buy it either. Why don't I want to buy it, Troy? It's going up. Now, you're really going to have a good lean if you buy this. You know, and this gets back to understanding time and market condition. You know, on a 30-minute time frame, this market has been really vertical. And if I go long here, well, where do I put my stop? You know, it's just normal rotation would be back into this area somewhere. So there's no good way to determine my risk. You know, you'll hear Troy periodically, and me too. There are times where the this market or that market, a lot of times it'll be the S&P. You know, tomorrow this number, okay, there's a number that comes out. Well, if the market takes off and you're not somewhere in that trade relatively early, regardless of how strong the move is, increasingly you don't have a good reward to risk whether it's going straight up or straight down, because you just there's no structure to gauge it. Okay, so here's the spike. This is right here is this. Now, there is a logical reason, there's an auction market reason that most of the time the spike, there'll be development preceding the spike of one form or another that will enable you to get off a graceful entry for whatever you want to do, whether it's to go long or whether it's to go short. And the reason for that is you fall back to the purpose of the market to facilitate trade. If the market becomes too one-sided for too long, it is at some point it's going to stop and rotate in a smaller degree time. And if that's setting an extreme, it's setting an extreme that is likely to be tested just because of the auction process. You know, markets go up until they run out of buyers. Markets go lower until they run out of sellers. Well, if this market spikes up here and then it begins to retrace, you're going to go back up. The market's going to take itself back up and rotate back up and test this. And then over here, you had your classic setup. Now, if you wanted this to, actually, you could buy this or you could sell it. You have a balance here. You have a lean. You have a positive expectancy here, whether you buy this or you sell it. Now, I happen to know, because I did the chart, this is the British pound, and over here that you can't see, this is spiking into, this spiked into, well, here, let me find it. I'll show you. No, that's not it. Hold on, I've lost my date. 1 second. Let's see. This was on February the 1st. Okay. So it's right here. Here we go. All right, now I'm going to go to 120-minute chart so we can get it on there. So here's this area, and it's spiked up into, we were in a downtrend. And we're going to get into why you would be looking for this in the first place in a minute. This is when you're in this is one of the trades that you want to learn to identify when you're doing your research. When a market is in an extended trend, you're looking for these retracements, and you want to find these setups like this. But you don't have to sell the spikes or buy the spikes. You're almost always going to get a more graceful entry. This is a trade you guys talked about in the room, Troy? Now, I keep beating this to death, and I do it for a reason. It's just a really tough way to make a living, and you can't identify your reward and your risk, and you will develop bad habits if you do this, because when you get the spike, when you get it, and it begins to go your way, you're going to get out of that trade as fast as you can. And, you're going to take, your $200, $300 profit, and you're gone. And what you'll do if you're focusing on that is you're going to miss the bigger picture of catching the move that you're in all day long. And instead of taking $200 or $300 out of the British pound, you could have taken, $800 or $900 per contract out of the British pound or some of these other currencies. Okay, this is gold. And gold is just classic. It is the spikiest contract on the planet. And most of the time, the spikes are, short-term highs and lows. And you have buying tails and selling tails all over the place in gold. And that can be a great contract to day trade. But you do not want to just rote sell these spikes in gold. It's unnecessary. Now, you can use the buying tails and the selling tails, but you have to let these things develop. Time. Give it time. Take your time. And this is that spike. Now, this is a 30-minute chart. It's not like this is a 1-minute bar chart. So this is a wonderful setup. And you say, well, gee, Tom, yeah, but if I sold this here, I'd have to put my stop here. Now, here's a little tip. No, you don't, because this balance area, if I'm taking this trade, I'm not going to put my stop above this spike. What I'm going to do is I'm going to assume this is a selling tail. If it's a selling tail, by definition, it's not going to be completely retraced. So if I enter this trade in here, I'm going to put my stop somewhere in here. I'm not going to put it above here, because part of my trade condition is the selling spike. And the assumption is that it's going to hold. So now I have a very well-defined opportunity to get a graceful entry in gold. And if you're patient and you're disciplined, gold can be a great contract to trade, but it can be tricky because it does spike a lot. I know some of you have been asking me about the day trading and which markets, and that was going to be part of the theme tonight. And this is gold. This is a 30-minute chart of gold. Now, one of the things you always want to do in any contract is keep in mind the larger degree phase of development. You'll see, if you listen to me in the DBSA, I'm very consistent. Something you're never going to hear me say is, well, gee, guys, this market's getting oversold. I think we might start looking to buy this. What you're going to hear me say over and over and over is the greater degree phase of development is down. I'm still favoring the short side unless this happens. And I do that consistently. And occasionally, this will happen, and then you adjust. But until this happens, you let the market tell you what it's doing, and you listen to it. There's no reason to guess. If you don't know, then move to a different market if you can't tell. But in this market, it's been quite clear and quite orderly for the last month what gold's doing. Now, it's gotten a little bit iffy in here now, but it's still interesting. But and you can take and you can trade the breakout of this balance area either way if you choose to do so. The phase of development is down. There's nothing wrong with favoring trades on the price side of the greater degree phase of development. As a matter of fact, later in the presentation, I'm going to make the strong suggestion that that's what you do. Over time, if you choose to step away from that for some reason, that's fine. But if you will put yourself in the way, in the path of least resistance consistently, you are taking advantage of this inherent edge that we talk about. So yes, this is a balance area, and yes, I would not want to be short if this market takes this to the upside. But if I'm biased to the downside, I'm willing to let that trade go too. And then I would wait to see what happens up in here, because this is the if the breakout of this is legitimate and it's not a false breakout, then this is probably where gold's going to go. But back to the spike thing. Now, if I'm trading this, if I'm trading gold and this develops, and I've got to be looking at a larger degree time frame to trade this way, okay? Now, what do I have over here? I have selling tails, right? So if I'm over here, if I'm doing my homework right here, let's assume this is in the evening, okay? I'm looking at gold and I'm saying, okay, the trend is down. What would I do tomorrow if gold rallies? Where are the points? What will I be looking at? Well, this would be a logical place that you would be looking. So then you can come into a day like this now, hold on a minute. I don't want to lose my place because I'm going to go down in time frame. I can go down to my 30-minute chart. And if I'm here and then I come in and I can see the market has rallied overnight. And then and the other thing, in gold and crude, you want to pay attention to the pit opens because a lot of funky things happen that you can take advantage of if you're paying attention. So sure enough, I'm sitting here. I'm aware of this area. I've highlighted this area on my chart. I have alerts set. Even if I'm not watching, I want to set my alerts to the potential to this area just in case something happens. And if the alerts start to go off, then I can go down in time frame. Oops. And what do we have? We have, a spike right after the pit open. And it leaves a selling tail. Now, in gold and crude, I will go down below a 5-minute chart. I'll use a 3-minute chart a lot of times. And there's enough trading that most of the time you can't use a 3-minute chart in something like, maybe corn, though I'll tell you that last summer you could, when it's really active. But if I'm looking at this market and I understand the implication of this trade location, and I have a bias to the downside, then when this market spikes up in here, now this is a 3-minute chart, but I have, I have 15 minutes in here to make a decision about what to do and how to do it. Actually, as I look at this was a great day to be trading gold. I'm thinking to myself, where were you, Tom? Story of my life.